Hello, and welcome back to my channel, The Midlands Investor, your one-stop shop for all things investing and personal finance. Today, I'm going to summarise the 5 key takeaways from the widely acclaimed book written by Lawrence A. Cunningham and Warren Buffett, called The Essays of Warren Buffett. Warren Buffett is a household name globally when it comes to finance and personal investing. He is one of the wealthiest men in existence and built his fortune making countless successful investments over and over again. He often boasts how he bought his first stock in 1942 when he was just 11 years old, and since then he has gone on to consistently beat the market by more than doubling the returns the market has seen over this time period. His compounded average growth rate is 23.8% versus the S&P 500, or the market, average of 10% over the same time period. He now boasts a wealth of over $82 billion. Buffett is currently the CEO of investment firm Berkshire Hathaway, and he writes a shareholder letter every year for the shareholders of the firm. Author Lawrence A. Cunningham has structured these letters into a book, which has enabled me to make this video today. So, without further ado, let's get into the top 5 takeaways of the Essays of Warren Buffett. Come with me on a journey to dive into the mind of a man that turned $1,000 into $82.5 billion. Takeaway number 1. Buy outstanding businesses at sensible prices. Warren Buffett's primary goal is to find outstanding businesses at sensible prices, not mediocre businesses at cheap prices. This is his most crucial piece of advice for me. Look for top businesses at reasonable prices. Look for companies that can drastically change their value for the long term, not those looking to make a quick buck or some short-term gain. A couple of common examples of great businesses that Buffett seems to like could include Coca-Cola or Apple, those businesses that have the ability to drive long-term sustained growth. Most of Warren Buffett's teachings are from the book referred to in my first ever video, The Intelligent Investor by Benjamin Graham. However, there is one clear distinction to be made between the two of them, and this is that Benjamin Graham preferred to buy at bargain prices, whereas Buffett found that buying great businesses at a fair price, and then this business went on to reinvest their profits, was a much better long-term play strategy. Takeaway number 2. Look for a high return on capital. As an investor, you want to own a company with a high return on their tangible assets. This is a measure of superior economic performance. The return on capital employed can be calculated in this simple formula, which is the EBIT over the capital employed, where the capital employed equals total assets minus current liabilities. A high return on capital employed suggests a more efficient company. Circa 20% is usually a positive sign for a company. The reason this is so important is because as an investor, you want a company that can keep adding more capital, tangible assets, and keep earning an above average return from these assets. A high return on capital typically attracts competition from investors. So as an investor, you must also look for barriers to entry. Barriers to entry are simply a moat that stops customers stealing parts of the market and away from your business. For example, a recipe, low operating costs, or a special ingredient. Extending barriers to entry and therefore driving competitive advantage is absolutely key in generating shareholder value. Where additional capital can be employed with barriers to entry, this is what a good investment looks like. Takeaway number 3. The intelligent investor welcomes market volatility. Volatility in the price of a stock can be seen as fatal by some investors, but Buffett argues the opposite. He states that short-term fluctuations are actually meaningless, other than that they create good buying opportunities for the long-term investor. The market is sometimes fearful, so strong companies sometimes have lower prices, creating an opportunity to purchase. As a long-term passive investor, you should actually hope for a market crash in the short term to create buying opportunities for yourself, so that in the long term you can generate significant wealth and returns. Buffett was once famously quoted as saying, "One must be greedy when others are fearful, and fearful when others are greedy." Takeaway number 4, identify extraordinary management. As an investor, you want extraordinary people to manage your business. If they think that owners in running the business, they'll have your best interests as investors at heart. As investors, we want the CEOs to run the business like it's their own. There are some red flags to watch out for as an investor. For example, if the CEO has promised to maximize shareholder value, yet he doesn't own any stock personally, and his bonus is linked to business earnings, is he appropriately incentivized to drive shareholder value? Probably not. There are some red flags to watch out for. Takeaway number 5, stay focused. A few big hitters is more valuable than lots of small-scale winners. Buffett states that diversification is important, but after a certain point, it is meaningless. Say as an investor, you had identified 30 businesses that you thought were strong businesses and that you wanted to put your money in. What would you do? Well, if you think anything like me, you'd probably think in order to spread your risk, you might put a bit of money in each of the 30 businesses. Right? Admittedly, you may skew more of your money towards those that you thought had the highest chance of winning, but the fundamental principle is you'd still be putting some money across all of your investments. Warren Buffett fundamentally disagrees with this view and approach. He states that you don't have enough time to analyse more than 4 or 5 businesses, and that there aren't that many good deals knocking around. His view would be this: put all of your money into your top 5 to 6. If you have done your research, have confidence in what the numbers are telling you. His view would be this: put all of your money into your top 5 to 6. You then have spent less time analysing lots of businesses and keeping on top of them all, and have the potential to truly maximise your gains over your core 5 or 6. And remember, Buffett's best holding period is forever. One good idea per year is generally good enough over the long term. So, to summarise, here are the 5 key points from the essays of Warren Buffett. So, to summarise, here are the takeaway number 1: buy outstanding businesses at sensible prices. Takeaway number 2: search for a high return on capital employed. Takeaway number 3: the intelligent investor welcomes volatility. Takeaway number 4: identify extraordinary management teams. Takeaway number 5: few big hitters are more valuable than many small-scale winners. And that's it. Thank you for watching. I've been the Midlands Investor. Don't forget to like and subscribe if you're enjoying this content, and I'll see you again next time.